Good morning, all. Sorry for a couple of minute delay starting this webinar, but today, for those joining us, we're going to talk about taking control of your retirement with an SMSF. Stop thinking, start planning. So we'll go through basically retirement and taking control of that, and how a self-managed super fund will allow you to do that. Now, just for everyone's information, this is being recorded today. If you've got anything that you want to think about afterwards or want to go back and listen to again, you will get a recording of this. And afterwards, you can share that with others that may be interested, should you wish to do so as well. Okay, so I'm David Maddock. For those that don't know me, I'm a financial advisor with Apt Wealth Partners, over 20 years experience, and specialise in self-managed super fund and retirement planning. Just a bit of housekeeping as well. Aside from being recorded, there is a chat function that you will have on the top of your screen, or should be on your screen somewhere, that allows you to lodge a question by typing into the chat group. If you have any questions, add those in. I'll either answer those at the time or at the end of this session for anyone that submits any questions regards to that. Obviously, this is just general information as well today. So if you are needing more specific financial advice, obviously we're happy to assist you in that regard, and reach out to us after today's webinar. So it is important to know that this is based on current superannuation laws and tax laws, and that we are a licensed financial advice firm, and like I said, general information only today. All right, so the agenda, some of the things that we're going to cover off on, start taking control of your retirement. A self-managed super fund is a good vehicle for doing that. So we're going to actually talk more specifically, just in general, first of all, how much you need in retirement, a question that often always asked, and then what does retirement look like for you? Understanding your investments, maximising superannuation. So the first part was specifically about the superannuation in general, and how you use super in retirement. And then we'll conclude in the last couple of points on what to consider when starting a self-managed super fund, and how can Apt and myself Adapt assist you and some of our other financial advisors in starting a self-managed super fund, and using that to take control of your environment, your superannuation in retirement. And lastly, a bit about Apt and our services. All right, so one of our favourite quotes here at Apt is, "At your end, you'll regret the things that you didn't do instead of the things you did do." So what's superannuation, retirement, all about? Generally speaking, it's not so much about just hoarding that money away for just because. It is obviously for the purposes of hopefully enjoying your retirement and all the fruits of all your hard work, and maximising that for you in retirement, so that one, it does last, and yet it can hopefully be stress-free as much as possible in retirement, and do the things that you've always wanted to do, whether that's travel, grandkids, helping in the community via volunteering, those activities, golf, etc. Whatever it is, obviously going to be individual to what you want to do, but let's make sure that we tick those things off. So thinking about retirement, so statistics say that, and this is from a while ago, was 1 in 5 Australians think about retirement daily or often. And I dare say, as you get older, so if you're under 40, under 50, you might be thinking it about a little bit, but as you get to 50, 55, definitely 60, I'm sure people, well, not sure, I know people are thinking about this all the time. And some of the questions asked: when's it the right time? Will I pay capital gains tax on any investments? Do I need a pension, aged care? Will my money last? What lifestyle? How much do I need? So all questions that will hopefully give you at least a bit of guidance today of what to think about as you start thinking about retirement. So the big question is, how much do you need to retire? And how much will the average couple likely need in retirement? So there are some stats out there, and there's some different things that you sometimes read in the media, whether it's 300, whether it's 500, with it 750, and the $1 million figure is often these days spooked as what's sort of needed to fund retirement in superannuation for retirement and potentially more. So again, statistics out there with a group called the ASFA, their 2025 report has said that for an average retirement, a couple needs $690,000 in superannuation, and a single person still needs a bit more than, no, not quite as much as a couple, but it doesn't drop just in half, but 595,000, just because some living costs, things like housing, gas, electricity, some costs are the same whether you're a couple or a single. So, looking at around close to the $700,000 mark for a couple, $600,000 mark for a single. That's making obviously a few assumptions that you're at least age 67 and you're getting a part age pension from the government. Now, what you're actually going to need in retirement is going to vary really from a couple to an individual basis and the lifestyle you want in retirement. So just to put that in a bit of context, these are the actual incomes that they talk about that a couple will need as a comfortable lifestyle in retirement. So for a couple, 75,000 just over is seen as a comfortable lifestyle in retirement. For a single, it's seen as $53,000 per year. So most people would obviously ideally want to be at that level. Some clients say that's absolutely plenty, that's enough. Some people will then know that's not going to be enough. And again, it really comes down to what lifestyle you want to live in retirement. If you're wanting more expensive holidays or upgrading the car regularly or help out kids or grandkids more often financially, well, you're going to need most likely more than that. But if you're wanting to just at least have some half decent holidays or at least regular holidays, pay bills, keep food on the table, and most people can at least live in those levels of income. That does have also the modest lifestyle, which is obviously a lot less and not less luxuries in retirement, but that's sort of seen as 34,000 for a single and a couple just under 50,000. Again, both of those scenarios assuming at least some age pension. And no debt, no mortgages or anything like that to pay. So as I alluded to, it's going to look differently per person. Things are phasing out of work, downsizing, cars, helping out kids, travel. All these factors come into your financial plan for retirement and also really determine what level of income and what sort of money do you need to have tucked away for retirement. Obviously, we want to make sure you're living your fullest life in retirement. So if we can do those things and plan for those things, ideally, that'd be great to tick off all of those things for people. And that's ideally like what we want to do in your personal retirement plan. Okay, so two types of retirees. This is, at the moment that we've had some volatility. The share market has come off a little bit recently over the last month. It has been over the last 3 years, though, doing really quite well and been in a really upward trajectory. Superannuation, property investments, fixed interest rates, economy, all these things do have an impact on investments and conversely have an impact on your balances in superannuation, in particular in retirement. So we've got generally what we see is two types of retirees. So the dark blue there is really the fluctuations still happen in the share market, whether in retirement, but living off as much as we can the income from your investments in retirement and allowing your capital to actually just continue to, we'll go up and down, but grow over the long term so that we're maintaining capital over time. So again, living off dividends from the share market, from share investments, distributions from exchange traded funds, managed funds, rather than having to sell shares, sell investments to fund your retirement. On the red line there, that is really eating into the capital on a regular basis. You're actually not just living off your income, you're actually also you're also eating your capital by selling down investments over retirement and unfortunately, you're eating into your capital. So what do we do and how do we work together? Well, we try to make sure that you're one of those clients that are on that blue side of the equation, that you're living off your income rather than capital to give you peace of mind, but also living the life that you desire in retirement. So some of the things on that checklist, we look at maximizing super, tax effectively managing your retirement, accessing government benefits, so the age pension, if you're entitled to that, surviving market downturns when they do happen, because it is part of investing, and ensure your income lasts a lifetime and living with no regrets. So what's going to happen in retirement? You're going to fund your retirement from a number of sources. So on the left-hand side there, you've got your age pension from the government that will provide you a fortnightly income if you qualify for that. You've got your superannuation. Your superannuation, particularly say your self-managed super fund, gives you a regular income, so you can draw via a superannuation pension called an account-based pension that can pay you fortnightly, monthly, an income to replace income from work. Then you'll hopefully have some savings as well in your personal name. And then you may also have some investments outside of superannuation. So that can be investment properties providing a rental income, shares providing dividends, and the like, that all go into helping you fund retirement. So a big part of investing and big part of retirement and managing a self-managed super fund is understanding your investments and taking advantage of knowing what you own in your investments within your super fund in retirement and helping you preserve capital for retirement. So this graph is a really good graph to just illustrate a little bit of what you could expect. And I think, you need to expect over, say, a 20 to 30-year time frame in retirement. So if you're, say, a 65-year-old and you might have a 30-year time frame in retirement of, eventually sort of, say, assuming passing away at 95, well, that's a 30-year time frame. And you can see here the 30-year time frame of the previous 30 years that we've just gone through, up to the end of 2024, shows you there how the volatility of the share market over a extended period of time. 22 of the 30 years have actually ended up at the end of each calendar year being in a positive return over that 12-month period. But you can see the red dots over a 12-month period. It is very common for the share market to be down anywhere to 15, 10 to 5% per annum at some stage in that retirement. Over that year, each year in retirement. So just managing that and understanding that you will see your super balances at some stages going down, but also understanding that over the long term, markets do rebound, and it doesn't always have to be, a 5-year turnaround. This volatility can be over a 12-month period of time. In 2025, we've seen April of this year, the market would have dropped, had dropped double-digit drop when Donald Trump announced tariffs being implemented in April, and the market rebounded, dropped quite dramatically on that announcement, but also rebounded within about a 2 week to a month time frame back to where it was prior to that announcement. So volatility and market moves are a normal part of superannuation and investing. It's just managing that through retirement. So what's the beauty of a self-managed super fund? Well, what it allows you to do is really absolutely take control of what you're investing in and knowing what you own. So Commonwealth Bank, you'll see that in the top left-hand corner, has been a really great investment for people over a extended period of time, and done really well the last 12 to 18 months to 2 years. And you can directly own Commonwealth Bank shares in your self-managed super fund. So what does that mean? You actually own Commonwealth Bank shares on the ASX. You get the dividends every fortnight, every 6 months. You get franking credits that help either pay tax on your superannuation, or eventually when you retire and in pension phase, you get a franking credit refund. So you actually get a franking credit refund each financial year for investing in Australian companies, but it allows you to actually see with confidence what you're invested in and know, well, Commonwealth Bank is still a really good investment, even if the market's down 10%, Commonwealth Bank isn't going anywhere and you feel comfortable with that. And you'll see a number of these big names, Visa, CSL, Amazon, Westpac, Bunnings being Wesfarmers, Google, which is Alphabet on the US stock exchange, Medibank Private, Microsoft, all these investments you can invest in and hold exposure to through your self-managed super fund and take real understanding of how your portfolio is structured. And it always advised that you're getting good quality companies that provide a good income that you can live off in retirement. So how can a self-managed super fund help retirement? Well, you can get control on how you draw upon your investments in retirement and take more control of preserving your capital. So, ideally, again, going back to that blue chart, that you want to be living off the dividends as much as possible. And you actually see the dividends come into your self-managed super fund. So you actually know exactly what the income is that your super fund is generating in a self-managed super fund. It's not, just getting a return at the end of the year, might be 8%, and you don't know whether that's income or growth, which often super funds will just quote you an end of year figure. It might be 3 or 4% of that was income, and 4 or 5% of that 8% return was actual capital growth. So we can break that down, and so you can know exactly what the income is that you're generating from your portfolio with the self-managed super fund. The other beauty when you go direct and have your self-managed super fund is, say you put money in a term deposit in the name of your self-managed super fund, you get the government guarantee per bank up to 250,000, like you do on any institution that you bank with in your personal name. So there is a protection there of investing cash in the bank up to $250,000 through your self-managed super fund. You can decipher between the growth, what the income generated from your self-managed super fund and the capital growth. And that's what I said in the first point, that allows you to preserve capital and take more control of investments by understanding how you're generating your return, and conversely, how that return is then helping you fund your retirement. You get to see the dividends, the distributions as they come in from investments. They can either be reinvested or be used to fund your retirement. Again, it's very clear, very transparent. You take great control of what income you're generating from your portfolio in your self-managed super fund. You actually control when you are realizing capital gains. So as an example, if you had one company that had invested in, say, Woolworths, that hasn't done much in the share market over the last 12 months versus Commonwealth Bank that actually has performed really quite well, if you did need to take some capital, say you needed to upgrade the car, you need $15,000 out of your super. If you didn't have cash to do that, which ideally we often try to plan that you've got cash out of your super fund rather than having to sell shares again to actually fund retirement. But if you had to, you could sell, say, from the Woolworths shares which hasn't had much capital gain, versus a Commonwealth Bank shares, which has a good capital gain, and you may want to retain that capital gain. And then minimizing tax. If you're in accumulation, so still haven't retired yet, you can still pay tax on any realized gains in super. Once you're fully retired, up to $2 million per person, any shares that you sell, you can actually pay zero capital gains tax. So again, that's where we provide advice in how do we actually draw upon your superannuation, if we can do so, in either now, whilst maybe potentially still working, because there can be some criteria by transition to retirement, or depending on your age, if you're over 65, but still working, how you're accessing your money in super in a tax effective way. And you get the full advantage of the franking credits. So the Australian system, again, using Commonwealth Bank as an example, pays a fully franked dividend at 30%. Maximum tax rate on your super is 15%. It can be 0% in retirement. You get a franking credit refund at the end of the financial year if your superannuation is 100% in pension and zero tax environment. So all of our clients in pension phase will get a franking credit refund or a tax return basically at the end of the year, where essentially behind the scenes there, we lodge a tax return for you, and essentially, and the government basically helps fund your retirement by giving you a tax credit as an incentive for investing in Australian companies. And the one unique feature that you can do with a self-managed super fund, which no other super fund can do. You can invest in direct property. So whether that's a residential property and you rent that out, or a commercial property, say a warehouse, an office space, anything like that, commercial property, it can be owned in your self-managed super fund. There is SIS legislation that you need to be aware of in if you are going to considering that, and on top of that, there can be things like collectibles, cryptocurrency, which I generally would say stick clear out of self-managed super fund, but they can be invested in a self-managed super fund if you really want to. But you do need to bear in mind that you do get audited each year as well. So just to bear that in mind with some of the investment decisions. All right, so using a self-managed super fund to survive a global financial crisis 2.0 scenario. So I've got the scenario here. If we were to have another big decline in the share market and it drops by half and then recovers over 5 years, which was pretty much what the global financial crisis scenario gave us back in 2007 and 8. We've got two clients here. We've got Max, who's a unitized super fund. Okay, so basically that means just a balanced fund where you've got Australian shares, international shares, cash, fixed interest, all in one pooled investment. So basically a balanced fund. Or you've got Jane, who owns her own superannuation. She has a self-managed super fund, and she actually can see what she's actually invested in and control how she's drawing upon her superannuation. So in both scenarios, they started with $1 million in super pension. They're drawing $6,000 a month to live, and they're spending that money each month in full. So Max just as the unit prices drop during a big decline in the share market and a very slow recovery, every month the fund maxes $6,000 per month, he has to sell more and more units as the unit price drops. By the end of the 5-year period, the market's rebounded and his balance is at 375,000 by the time it's after that 5-year rebound has taken place. On conversely, Jane, what we've done, we've put some money in her self-managed super fund and just isolated some cash, term deposits, and defensive investments to help weather some storms and haven't had to sell shares out of the share market during a 5-year period. Jane continues to receive those dividends and gets interest on her cash, and she continues to take her monthly $6,000 from cash, leaving her investments largely intact and be able to get the full benefit of the full recovery of the share market. So by the time the market recovers, her balance is $838,000 and Jane is $463,000 better off. Now, the scenario more recently, say again, using Commonwealth Bank as an example, during COVID in March of 2020, that dropped to about $60 a share. If you had to progressively sell every month out of the Commonwealth Bank to shares to fund your $6,000 per month, you've missed out on that recovery and haven't had that full recovery. By the end of 2026, 2025 this year, we're sitting at about $160 a share for Commonwealth Bank to $170, depending on what day you're looking at it. You've actually missed out on that full recovery if you have sold shares over that 5-year period, where ideally we just want to, again, stay on that blue line, live on the dividends and let the share market rebound as much as possible before we're having to actually sell down any investments. So maximizing super, what can you do to put money into superannuation? How do you get it into your superannuation system and why should you do it? So why is superannuation a good investment? It helps reduce tax on your personal income tax. It's tax effective earnings. It's a forced savings for retirement and what we like to say, live for today, plan for tomorrow. So putting some money aside for retirement. Effective estate planning tool because money in superannuation can go onto spouse and on then children, whether minor or adult children. Tax-free income in retirement, so post 60 and thereafter, you can actually draw tax-effective, tax-free income from it up to $2 million per person in superannuation. And and can support your business. If you're wanting to go down the self-managed super fund path to say some secure commercial property, you can, if you own your own business and want to, rather than rent, buy a property, you can buy property in your self-managed super fund and then rent that from your self-managed super fund to help, again, boost your retirement. So the tax effectiveness, the main tax, or the maximum tax you pay on superannuation is 15%, can be lower depending on your stage of life, either in accumulation or retirement. But yeah, most people are at least on above the 15% tax rate, meaning that it's more tax effective to invest in super. So superannuation contributions. So there's largely two types of contributions that you make. So you'll see in that blue box, concessional contributions. They are the part that you can get a bit of a tax deduction for, the tax effective part of reducing your personal income tax for retirement. So employer contributions, that's tax effective, that doesn't add to your personal income tax. And then you can salary sacrifice more money into superannuation up to a total of $30,000 per year, and that will help reduce tax. So just a way as an example to explain that further, you say your employer was to pay $10,000 a year into superannuation for you, that goes towards that $30,000 limit. So you can put in another $20,000 to take it up to that $30,000 limit, and that $20,000 further reduces the tax on your taxable income, because it's effectively salary sacrificing, saying that, well, I'm not taking that income, $20,000 as an additional wage. I'm actually going to pay that into super as a salary sacrifice as a pre-tax contribution, and that would reduce your personal income tax. On the right-hand side in that yellow box, there is also what's called a non-concessional contribution. So you don't get a tax deduction on that money going into superannuation, but you are tax effectively building up wealth in superannuation for the long term. So that is a personal contribution that can be up to $120,000 a year, as long as your superannuation balance is below 2 million. Or you'll see in that bottom right-hand corner, you can complete a 3-year catch-up contribution. So basically what that means is 120 times 1,000 per annum times 3, you can put up to $360,000 in one financial year if you've got that capacity to do that, and that's the your 3 years worth of contribution. So essentially, you can't put any more money into super for this financial year and the subsequent future 2 financial years, being 3 years in total. That also counts towards a non-concessional contribution limit is if you put $1,000 in, you get the government co-contribution, or you put $3,000 in for a dependent spouse and get the spouse contribution. So the benefits of why you might want to consider that, particularly as you get closer to retirement, is that though there's no tax deduction, any earnings are taxed a maximum of 15%, where most people, their earnings on investments in their personal name are taxed at 30% above. So there is a tax savings of putting money aside for retirement in both scenarios. So just highlighting again the concessional contribution caps and the benefits. If you're under $18,200, well, a lower income, there isn't the same tax effectiveness of putting money into superannuation, because, as I said, the tax limits, or the tax rate, is 15%. But between 18,000 and 250,000, if that's what your income is, which is the vast majority of people, you are saving a fair significant amount on any tax on any amounts that you put into super. So as you creep up the tax brackets, it can be a 6% tax savings, 19.5% tax saving, 24%, or even between 180 to 250,000, it can be a 32% tax savings on those amounts that you put into superannuation. It is a little bit different when your income goes above 250,000, you're still in that 47% tax bracket, but there's what's called a Division 293 surcharge. You do pay an additional tax for those larger income earners, so it does creep up to 30% on those concessional contributions. So there is still a tax savings. It's just 17% as opposed to the higher tax savings for some lower income earners. All right. There's two phases predominantly that your superannuation in a self-managed super fund environment will be in, depending on your stage of life. So most workers, most people still working, getting a wage, they'll be on the left-hand side, what's called accumulation. So what happens is employer contributions taxed at 15%. Any earnings on your superannuation can be taxed at 15%. But then from 60 onwards, you can convert your superannuation to a pension, and that's what you'll see in the middle of your graphic there. And that's up to $2 million per person can be invested in a pension, and the tax rate drops to zero. So that means no tax on any capital gains, no tax on the earnings, and it can actually be withdrawn tax-free. The only criteria that you have to make, you firstly make an election to go from accumulation to a pension, but you are subject, once you go to a pension environment, to the minimum annual pension amounts that you'll see in that box on the right-hand side based on your age. So between 60 and 65, the minimum is 4%. And as you get older, your minimum pension accounts as a percentage actually increase. So 65 to 74, it's 5%, 75 to 79, 6%, 80 to 84, 7%. And that's normally just in most cases, or all cases, based on what your superannuation pension balance is on the 1st of July of each financial year. So simple terms, if you have $1 million, depending on what your age is, $1 million at age 60, you'd have to take $40,000 out as a pension income tax-free. That's the minimum. From 65, $1 million at 5%, 50,000, 75 at $1 million at 75, 6%, and you get the picture that essentially that's the minimum pensions that you take each year. And so ideally, again, sticking on that blue graph, we want at least a 4%, 5%, 6% return as you get older to at least preserve capital as much as possible. And if you can live off the minimum, that is a very doable a goal to be able to achieve to maintain your capital in retirement. One thing to also be aware of, if you haven't been maximizing your super in previous financial years, that there is what's called a catch-up amount that you can use. So the criteria is if you haven't maximized your superannuation for the previous 5 financial years and your super balance is below 500,000 as of the 30th of June of the previous financial year, you can actually use any catch-up amounts to basically catch up from the previous 5 years that you didn't maximize your concessional contributions. So this is an illustration of from the 2021 financial year to the end of the 2025 financial year just gone. Essentially, they've made a contribution of $15,000 in the 21 financial year, no contributions in year 2022, no contributions in 2023. Those amounts carry forward. Then a $15,000 contribution in 2024, and then a $10,000 contribution in the financial year just gone, 2025. But based on adding the caps over those years and bringing those forward and carrying that forward, there's actually a $107,500 amount that could have been contributed. Sorry, that's the catch-up amount that can be contributed based on the amounts that haven't been utilized of the caps over the previous 5 financial years. So that can significantly reduce your tax, and also can significantly reduce potentially capital gains tax if you haven't been maximizing super, but say you've got an investment property that you've been concentrating on, you're selling that, or selling any large investments, realizing a capital gain, and you have a super balance below 500,000. This is really powerful in reducing significantly the tax that you'll pay on on those investments by putting money into superannuation. So definitely worth thinking about. There are a couple of small wins that we can get for you as well. They all add up. So the government co-contribution on the left there, if your income's below $62,000, you can put $1,000 into super as a personal contribution. The government still matches that. They've done that for a number of years now, up to $500 to a bit of an incentive to put a little bit extra into super for you. And then if you've got a spouse that earns below $40,000, if you put a $3,000 spouse contribution in, the partner, the husband or wife, that's put it into for their partner, they get a $540 tax offset. So essentially, you're putting $4,000 into super, if you can take advantage of both of those, and you're getting an $1,040 benefit for that. There also is, that's been around for a little while now, the downsizer contribution. So if you're downsizing the house, I'm thinking about doing that in retirement. You can, from 55 onwards, as long as you meet certain criteria, sell your home, downsize. If you've freed up some money from downsizing the actual home, you can put a contribution into superannuation $300,000. Now, that isn't subject to the $2 million cap for super balances, and that's on top of that $120,000 non-concessional cap, or the 360 if you're doing that for 3-year contribution. And you don't have to worry about the works test. So that can basically be from 55 onwards. You can be, in your 80s and still make that contribution if you meet that certain criteria and want to put money into super. The only thing to be aware of, it can be an impact on your age pension entitlement. So the family home does not count towards the Centrelink and asset test assessment for Centrelink or the age pension. But as soon as that money has hit the bank account, 300,000 in the bank, whether it's in the bank or superannuation, it doesn't matter. Downsizing your house does contribute, freeing up that capital towards the asset test for age pension assessment. So you may reduce your age pension or knock yourself out of getting the age pension altogether. Okay, using a self-managed super fund to protect beneficiaries. So because you're a trustee of your own self-managed super fund, self-managed super funds can really quite effective in making sure your benefits flow on to the next generation, assuming each other in the first instance, husband or wife, if you're married, but the more probably one that needs to sometimes give some thought is how it flows on to adult children. So you can have a binding death nomination, or what's called a reversionary death benefit nomination on your pensions, and you can also put options in often your self-managed super fund. So what I mean by that is husband and wife in your first instance, and then if anything happens to both husband and wife at the same time, hopefully not, but in the worst case scenario, car accident, they pass away together, you can have an option to goes on to adult children, or as per the estate, or however you want that to flow on. So most super funds, aside from self-managed super funds, don't cater for different options in different scenarios. They just has husband and wife, and then just defaults to the will often in the second instance. But you can control how this flows on, and you can have your children involved in your super fund if you want to as well, because depending how big your family is, you can have up to husband and wife potentially, and then 6 members of the self-managed super fund. So you can bring your children into it as well, even before death, if you wanted to. And also, self-managed super fund is really good, and been able to take advantage of a recontribution strategy. So what that basically means is adult children, if they inherit their parents' superannuation, if they haven't made considerations for this, basically what can happen is there can be a 17% tax on the amount that they inherit to adult children from their parents' super. So using $1 million as an example, if that's all what's called a taxable component and goes on to adult children, there can actually be, which a lot of people aren't aware of in that scenario, $170,000 of tax paid by adult children before they actually receive a dollar out of the self-managed super fund. So we look at strategies and ways of basically eliminating that 170,000 if we can, or at least significantly reducing that. All right, so I'm going to use, because that's such a powerful and big potential expense, $170,000. I've got an example here of how that can be used to take advantage of recontributing to super to minimise or reduce that tax. So we've got Tom and Jane, age 63, both retired. Jane has $720,000 in her account-based pension, all contributed over a working life by her employer. And Tom has no super. He's been self-employed and never contributed to super. So the family, being Tom and Jane, overall have $720,000 in superannuation. Once Jane and Tom pass away, Jane's kids inherit the money from the superannuation, 17% tax. In this particular scenario, it's 122,400 in tax. So let's get it out, avoid that, and by completing a recontribution strategy. So what would that look like? So Jane has met a condition release. So what that means, she can access that $720,000 balance tax-free. She could take that physically out of her superannuation in 100% out if she wanted to, and put that money in the bank. As Jane and Tom are still under age 75, what they can do, remembering those contribution caps I talked about of 360,000 being the absolute maximum you can put into superannuation on a non-concessional contribution, essentially take the advantage of those contribution limits. So 720,000 comes out of Jane's super. It hits the bank for a day or two. Then we put the $720,000 back into super, into the self-managed super fund, but 360 goes into Tom's name, 360,000 goes into Jane's name. That allows us to then convert that 720,000 that was 100% taxable upon death to 100% tax-free upon death. So we've saved the estate $122,000 with a bit of planning around that. And just care needs to be making sure that we're not going over that $360,000 limit. But if we do this right, we can eliminate tax in this scenario, or in that, say, $1 million, we can at least get $720,000 out. So, and back into super, and really significantly reduce tax on the estate. And potentially look at it again down the track in a few years' time after the 3 years, and do it again up to age 75 if allowable to get it entirely tax-free. I'll just touch base on this one quickly, just because there's been a bit of talk over a number of years now almost of Division 296 tax. There was some changes announced recently to this drafted legislation, so it hasn't passed. Basically, Division 296 tax is super balances is above $3 million. The government is looking to have additional taxes applied to that. The main taxes that will apply to that is that third dot point there, tiered tax rates. So what happens is, if you've got a super balance between 3 to 10 million, it's proposed that there will be additional tax of 30% on the earnings. And then any super balances above $10 million, 40% tax on that earnings. So anyone below that, the tax rate is 15%. If you're up to, in pension phase, up to $2 million, that's 0% tax. But the government is saying, well, okay, anything that's above the 3 million mark, you're actually going to pay 30% rather than 15, and then jumps up to 40%. So if you're in that scenario, first, it hasn't been legislated yet, so we want to wait till that's to be passed, because originally it was going to look a fair bit worse and be taxed on unrealized capital gains, which is a really good thing that no longer applies in the proposal. But you are going to need to get your own specific tax advice, because there's a number of different option scenarios depending on your position when it comes to this type of scenario, and it's going to be very unique to your individual circumstances. And these thresholds will be indexed by inflation. Originally, again, it wasn't talked about not being indexed, the $3 million balances, so they will be indexed over time. So, and they're also increasing what's called the low-income super tax offset for low-income earners. At the moment, they get a bit of a payment from the government for low-income earners deposited into their super. That's going to increase from $510 to $810. So the main summary, though, is above $3 million, there's no tax anymore on unrealized gains, and the tax rates are going to 30% and 40%, depending on your super balance between $3 and $10 million. All right, so what to consider with starting a self-managed super fund. So if you believe a self-managed super fund is for you, these are going to be some things that you really need to think about, and some things to consider. So you're wanting to start a self-managed super fund, now what? Engage with Apt self-managed super funds administrators. So you will have to, when I mean administrator, generally they always are qualified accountants or tax SMSF tax specialists. You do need to engage an administrator for your self-managed super fund. So that will mean that lodging your tax returns with your self-managed super fund, getting it audited, making sure that we're doing everything right to make sure the tax office is happy with your self-managed super fund, because they are regulated by the tax office. And we work very closely with a number of professionals, both across all of our offices in Melbourne, Sydney, and Geelong, to make sure that for clients we're ticking off on that. You also need to consider what type of trustee that you have, an individual or corporate trustee. And individuals that be Mr. and Mrs. Smith as trustee for the Mr. and Mrs. Smith Super Fund, or a corporate trustee will be Smith Proprietary Limited as trustee for the Smith Super Fund, or however you're going to, whatever super fund name you use. So it is need to consider how you've structured it. I generally would recommend you consider a corporate trustee if you're going down the corporate, because it makes it easier for long-term planning. A corporate trustee, you become a director of your own company, and it does mean you need to apply for director IDs, which is something that you need to consider. What happens with the self-managed super fund? You get your own ABN for the self-managed super fund. You get your own tax file number for the super fund. So it's an own entity in its own right. And so it has its own document, own numbers that, again, for lodging and recording through the tax office. You need to establish the trust deed for the self-managed super fund. So the trust deed is a legal document that stipulates the rules and what needs to, how you are going to manage your superannuation and retirement. Again, we generate these documents for clients. They don't know, you need to go out and source those, but again, you do need to have a document that stipulates what your super fund rules are. So you've got your trust deed rules and what you need to abide by there, and you also got superannuation legislation. And the first thing when you start up a self-managed super fund, the auditor, the tax office will want to see the trust deed. Complete a self-managed super fund investment strategy, and that means they mean a documented investment strategy. So you do really need to give serious consideration to how your investments are being managed in retirement. It shouldn't be just something that you're using to speculate. It needs to meet the sole purpose test. It needs to be making sure which is investing money for retirement and the purpose of building wealth for retirement. So your investment strategy needs to be documented and reflecting that. You need to register for SuperStream for an electronic service address. So what happens, there is a system there that all money, obviously in superannuation, it's a $4 trillion pot of money, and self-managed super fund makes up about a quarter of that. So about $1 trillion in the self-managed super environment. So money's moving all the time electronically around Australia in self-managed super funds, and by employer contributions, pension payments, contributions, rollovers, and all needs to be tracked, and it's tracked by SuperStream, and you set up what's called an electronic service address for tracking transactions. So your employer will need an electronic service address to be able to make sure your contributions are being made appropriately into your self-managed super fund. And when I say appropriately into your self-managed super fund, it goes into, and the second last point, a self-managed super fund bank account. So the bank account is there just like any other bank account, very transparent. You don't get any more transparent than a self-managed super fund, or seeing the money, how it flows. It goes into your bank account, say $1,000 employer contribution goes out, hits the bank account, and then you can, as that builds up, you can then go invest that money. Conversely, you need to roll over, say, money from another super fund into your self-managed super fund. That goes into the self-managed super fund, tracked by the electronic service address. As soon as that cash rollover hits the bank, then you can go invest that in the name of the self-managed super fund. So there are some things to consider in more broadly setting up a self-managed super fund, because there are a bit more involved than is more involved in your normal super fund. There is increased time requirements. There are increased documentation requirements. So if you're not very bit time poor, not very great at managing documents, which in reality is we do this for clients, so they're not having to stress about this as much. But come the end of the financial year, there is quite a lot of documents that you need to sign off on for your financials, for your audit, for your compliance requirements. That's where ourselves as a financial advisor, working with the SMSF administrator, do all that for clients. But you do have to have a level of understanding of the requirements of your self-managed super fund. I alluded to this before as well. Sole purpose test, you need to abide by the SIS Act. So self-managed super fund shouldn't be for speculating on your money in retirement. It's still supposed to be for retirement and there for retirement. You do have control over the investments. You are got a lot more scope on what you want to invest in than pretty much any other super fund, but it still should come through the goal of the long-term retirement planning and how's the investment decisions you make going to eventually help you fund your retirement when you're ready to retire and generate an income. So say, for example, sometimes you might hear people say invest in gold. Well, that you can invest in gold, but that's not going to generate an income. So whether you need to think of how I'm generating an income eventually in retirement as well. Investing in land or property that's not generating any income, you really need to generate income producing investments in retirement, eventually for retirement, so that you've got an income being supported from your investments once you do retire. A self-managed super fund needs to be domiciled in Australia, so that means that it needs to be all managed and monitored in Australia. It doesn't mean you can't go on holidays by any means, but it does mean if you're going to permanently reside overseas and an expat and never going to return to Australia, a self-managed super fund isn't for you. If you are going to reside overseas for a period of time and come back to Australia, well, you do need to consider whether a self-managed super fund is for you as well. So essentially, it's for Australian citizens mainly residing in Australia. You can go off for a holiday for 3 months, 6 months, or whatever, but essentially, the idea is that you're back in Australia or have people in Australia that are managing it for you on your behalf whilst you're overseas. A self-managed super fund needs to be independently audited every year. So again, we've got our own administrators, we've got our own, we provide the financial advice, but independent of all that is a third person that we engage an auditor. So an advisor, an accountant, or a SMSF administrator, and a separate auditor that's all monitoring this for you and making sure that the super fund's being compliant, and they report to the tax office whether the super fund's being compliant or raise a notice if they don't believe that it is compliant. So that's part of the ATO compliance requirements, and they do need to be done in a timely manner. So you can't just let these things drag on with the ATO. They need to be done in a manner that is timely and at least annual for your financials, and they need to be done by at least May the following financial year. But if you are starting pensions, retiring, you do need to update more frequently, at least during those periods of time. Also, one thing that often people don't think about if they are winding up an old super fund to go into a self-managed super fund is the insurance needs. They may have insurance through their current super fund. You can get insurance through a self-managed super fund, but make sure that you're not losing any benefits or uninsured for a period of time before rolling over your super into a self-managed super fund. So, and that goes on to the last point. There may be some other benefits that you should consider that you may lose upon closing your old super fund. So we always do that for clients, but it's always worth double checking with the employers paying a higher level of super for you in your current super fund, whether there's some defined benefits, whether there's some other things in your super fund that you currently got that may mean that a self-managed super fund isn't for you. So how can Apt assist in managing your super? Well, there's a whole bunch of areas where we assist the accounting, the wealth protection, be the insurance side, that we manage the super and investments on behalf of clients. We can make sure that your direct investments as much as possible align with your ethical investments, if that's what you prefer. Legal benefit documents, so your trust deeds, your estate planning documents, how this all funds through, how we make sure your estate planning is being managed and flowing on to the next generation, making sure the cash flow is being managed, that whether you've got any government entitlements that may benefit you, take advantage of on top of your self-managed super fund, and obviously ongoing management of all of these through your retirement. So that you don't hopefully have to stress too much about your retirement, because we can see quite clearly through your self-managed super fund, the income that's generating and the returns you're getting is funding your retirement. But we basically, in a nutshell, we can help you with all parts of a self-managed super fund and monitoring that for you, and complete that all in a timely manner. A little bit about Apt. We're a national financial planning firm, over $3 billion of clients that we funds under management, predominantly in superannuation, offices in Melbourne, Sydney, and Geelong. We've been recognised by a various number of groups for our work in the financial planning space. We support a number of charities that you can see in your top right-hand corner. I'm supporting Movember. I don't always have a mustache, but yeah, we obviously community minded, but also privately owned firm. So again, why a self-managed super fund? We don't have our own products. We don't have our own, super funds. Whether a self-managed super fund is for you or some other type of super fund, we find the solution that best suits clients. So in closing, now you've taken the first step. You've obviously listened to this seminar, webinar. If you believe that you want to take that next steps and ready to take that next steps, I couldn't stress enough that I think taking control, whether it's a self-managed super fund or some other super fund, but understanding how your superannuation is operating, working, and assisting you in achieving your retirement is money and time well spent in investing in that, because that will ultimately give you peace of mind of knowing, okay, yep, I can retire, not retire yet, or what does it look like for your retirement. So reach out. That's our contact details there. 1-800-801-277. Our email address there at info@aptwealth.com.au, or go to our website. You'll find me and various other staff and contact details that can assist you across our various offices. Okay, I'll draw a breath. I'll just have a look and see if there's any chats in the chat group there. No chat group questions today. So hopefully I've covered off on everything, and it seems hopefully I've done a good job that there isn't questions, because I've answered all of them. If you've got any questions, reach out. I'm happy to take any calls or have a meeting, either in person or by video. And ultimately, we're here to help you to live your best life, and don't live with any regrets. So thank you.